Good afternoon, everyone. We appreciate you guys taking the time to meet with us. Again, we're going to be discussing ASC 606 and how we can help you enable compliance inside of Dynamics, particularly GP. Again, my name is Peyton Lupo. I'm the account manager here at Binary Stream. I work very closely with Brad and the Turnkey team to help deliver solutions to their Dynamics clients. I also have on the line with us Don Ramsey, our solution consultant. So quickly about Don. Don's going to be doing most of the presentation for us here today. Don's been an accountant for over 26 years now, and before his life here at Binary Stream, he was also a Dynamics GP consultant for 5 years, and after that he's been with us for about an additional 5 years as a Binary Stream solution consultant as well. So a little bit about Binary Stream, who we are. We are an ISV, or an independent software vendor, delivering solutions to the Dynamics ERP since 1999. So what that means is, being an ISV, is our solutions are embedded within the ERP. So some of you may be familiar with some of the modules Brad already mentioned: multi-entity management, subscription billing, among others, that we deliver to enhance the functionality of your Dynamics platform. And again, we have solutions across Dynamics GP, on Dynamics 365 Business Central, as well as finance and operations as well. And then the module we're going to be talking about at hand later on in the presentation today, after Don speaks to ASC 606, is our subscription billing suite. And this is the one that helps to enable compliance with 606. We're going to be primarily discussing it in GP today, but understand that it's available for F&O and Business Central as well. So if you guys are looking to migrate to the cloud sometime in the future with Business Central, the functionality that we are going to be discussing today will be available there for you as well once you guys are ready for that transition. And then for the agenda, we're just going to hand it over to Don after this to talk about what is ASC 606, the 5-step recognition model associated with it, the differences between ASC 606 and IFRS 15. So ASC 606, obviously more of a North American and American standard, where IFRS 15 is more worldwide. They're very similar, but there are a few differences that you may want to be aware of if you guys do have, entities or business units in other parts of the world. That could be something that is a concern for you. And we'll touch on the areas of concern for 606 adoption, touch on how you can be ASC 606 compliant inside of Dynamics, and we'll show you a brief demo at that point as well. And then, as Brad mentioned, we'll finish off with any additional questions at the end. And that's it. For me for now, I'll hand it over to Don to get started on the presentation.
All right, folks. Again, I'm Don Ramsey, the mug that you saw a couple of slides earlier. That's me. I want to talk a little bit about the agenda just to give you some understanding of what's going to happen. We're going to be taking a look at a lot of slides, a lot of PowerPoint presentation, and a lot of it is complex because ASC 606, IFRS 15 is complex. But don't worry too much about remembering everything I tell you about the slides. You're going to get the slide deck. And not only that, you're going to see from some of the dates in our presentation that things are pliable. What happens this year in ASC 606, when it's going to be applied, what the year end is supposed to be, can change and has changed already and might change even again. But the basic reality is that eventually people are going to be accountable under the ASC 606 or IFRS 15 standards, and they need to be ready. You certainly don't want the auditors coming in and destroying your books because they're not compliant. So we're going to hopefully show you the complexity, but have faith. We're going to get to the point where we show you a little bit of the ease, too, of actually utilizing ASC 606 within the GP environment. And as Peyton rightfully said, whether it be the GP environment, the BC environment, or F&O environment, all of that will have the same application, the same process capability. So we will talk about different areas of concern. We are going to talk about how to become compliant, and then we'll leave the end for Q&A. So again, please feel free to put your questions in the question box so we can discuss those in the last, say, 15 minutes of the hour. So let's get going. What is it? Well, these standards ensure that revenue recognition is consistent across all industries, capital markets, geographies, and so on and so forth. And basically, we're talking about contracts with customers. Right now, there are some exceptions. Leases, for example, come under yet another standard of accounting regulation. There's also insurance standards and banking standards. But for most people who have contracts with customers, or most customers who have contracts with other customers, ASC 606 or IFRS 15 is going to apply. And even though it's technical in nature, the attempt was to make it less technical, more principle-oriented than rule-based oriented. So a lot of things disappear. As you notice there in the third bullet point, VSOE, TPE, BESP, all disappear, except little pieces of them. Perhaps they thought these were the best pieces of each of these little methods we're going to take and we're going to put under the ASC 606 compliance regulations. So the real key point is that last main bullet point, recognition, or revenue recognition elements, performance obligation, distinct identification of those obligations, even variable consideration, things might not be too clear, and time value of money. For contracts that typically extend for a lengthy period of time, we might have a net present value to consider and to account for in our books as well. And of course, transfer of control. When does the contract end? When does the person who's paying the bill take control of all the benefits, and so on and so forth? Those are the things to keep in mind. But again, detail here, please just put it back in the back of your mind, and you'll have the slide to walk through that in more intensity at a later date. Of course, as I mentioned, old standards, rule-based. Can't do this, you can do that, you have to do this, you have to not do that. Now it's more principles-based. What is the real value? Who has ownership? What's the percentage that you have to look at? A lot of it's going to be based on what you decide as a company for your industry. But still, when the auditors come in, they're going to be comparing that to other industries that are similar to yours, other businesses that are in a similar industry to yours, and they'll find out if you're using common sense and logic and you're following the principles as they were meant to be outlined. So let's look at the 5-step recognition model. This is still in place despite the evolution of the standard. Basically, you want to identify what is an actual contract with a customer. You might have 2 or 3 contracts. Are they essentially one contract, for example? Or is it even a contract? We'll talk about that a little bit. Then once we have the contract identified, what are the performance obligations? What do I have to do as a company in order to satisfy this contract and be able to recognize the revenue that I want to recognize? And what about my transaction prices? What about free items? What about discounts? Well, really, what the gap requirements are saying is, nothing is free. Everything has a value. Discounts, you don't put discounts on the balance sheet of the P&L. They don't exist. They're just a change in the actual price. So we need to allocate, as point 4 mentions to us, what the real revenue is based on the standalone selling price of each item on the contract. So I might have hardware on the contract. I might have professional services. I might have a maintenance contract there, one-time items, monthly billable items, annual billable items. What is the real value if you sold any one of those items by themselves? That's going to be the key in calculating what you do with an item that suddenly is free, or all of a sudden an overall contract discount of 10 or 15%. How do you do that? How do you account for that? It's not actually that difficult, but can you imagine if you've got hundreds, if not thousands of contracts out there, and all of a sudden you have to manually calculate what the real standalone selling price is, take that, do the math, come up with a number, and now put a journal entry in there to recognize the appropriate amount of revenue at the appropriate time. That is Excel being used for what it was not designed to be used for. Excel is an analytical tool, not an ERP. But all too often now we're finding that people are using it as an ERP. They're tracking down what their deferral should be. They're tracking down what their contract should be based on a spreadsheet. And I am going to show you a sample. Actually, it was a real life sample in a spreadsheet of how that can be done if you decide to do that and not move forward with a product like this that can calculate it for you. And of course, then we need to figure out the final point. When can we actually recognize the revenue? What constitutes satisfaction? It's done. We've obliged the contract. We finished the services. And we'll talk about that as well. So identify the contract. Question then obviously is, well, what is a contract? I'll finish my lunch on time. I'm not going to dawdle. My teacher gave me a fish sticker. I'm going to pick out a goldfish for the class when I have 10 stickers. Signed, Raoul. And the teacher's name's there and the day's May 8th. That's the contract. There's obligations there. There's performance obligations. There's timelines. There's expectations. It's all going to happen if the young fella actually follows through in that. Obviously not a contract we're going to worry about, but that's a contract. Again, what's a contract? How about this one? I looked at this and when I first saw the slide, my first reaction was, Lawyers, that's a contract. More boilerplate in there and detail than you and I would ever read. And obviously, a little bit exaggerated in the amounts of intensity. But that's a contract. Everything's written in paper. All the terms are there. All the obligations are there. And yes, this would take forever and another team of lawyers to go through. But that could be a contract as well. But again, what's a contract? A handshake can be a contract. Depending on where you are in the world, there are different ways of solidifying a contract and confirming an agreement. And a handshake, believe it or not, is still a popular way of doing it, although underneath the hand, you'll notice it says contract. So they've got it in writing as well. But this is now saying this contract is signed, we're ready to go, and we're ready to put it on paper, put it in the ERP, put it in GP, and somehow try to account for it. One more time, what's a contract? This is going to be a little more familiar to most of us. There's an invoice. The invoice has a bunch of items on it. These are deliverables. They have to happen. This is a contract. And again, maybe this is not going to be too unique. ASC 606 may not apply here very much, but if there is a freebie in here, a discounted price in here, a discount period, it's going to be a contract that we need to reallocate the dollar amounts for. And so finally, let's identify a contract in words. Two or more parties involved, enforceable rights, enforceable obligations. It's only the customers. So this is between a business and its customers. And of course, if you're not sure of that, again, that phrase, talk to your legal counsel, I want to emphasize that. I'm an accountant, and I understand the basic requirements of ASC 606 and IFRS 15, but I'm not your accountant. I'm not seeing your books. I'm not understanding your business. So please don't take my word as the absolute be-all and the end-all. I'm giving you a high-level overview of it, but when it gets down to the details, who actually is my customer? Are they my customer? Are they my partner? That might be your legal counsel or your CEO or your CFO that has to decide that for you. But after you've done that, the agreement has to have commercial substance. There has to be something financial in the agreement. Everybody has to agree to it. You can't have a one-sided contract where you say we're going to do this and the other party goes, no, we're not. That's not a contract. There has to be agreement. And identifiable rights. What's going to happen to this good or this service or this piece of hardware when the contract is done? Who's going to own it? Who has the right to it? Did I pay for it? And so on and so forth. And there, that leads to that next bullet point, specific payment terms. And this is an interesting one. The second last bullet point, have a probability of collection. Threshold is más o menos 70% certainty. So you can't recognize the received cash as revenue unless the collectability is probable. That becomes an estimate that you have to honestly make whether or not there's a contract there. And obviously, for the most part, that doesn't come into play very often. You mostly make contracts with reputable customers, and you know the collectability is there, they intend to pay, and you intend to collect. One final point in the slide. We allow you in our product, and most other products do as well, to add items to existing schedules or existing contracts. And you can add a lot of items, and you can increase the value of the contract. But technically, if you modify a contract to a point where the dollar value changes significantly, or you add new items to a contract, it essentially means it is a brand new contract, not just an expansion of an existing one. Now again, that is not a point that is highly tested or highly questioned by most auditors, but you need to keep it in mind. It is a part of the ASC 606 standards. Now, I mentioned earlier that you can take a look at multiple related contracts and you could tie them all together and say, you know what, essentially, even though this is different paper, different contract number, this is a single commercial objective. We're trying to do the same thing, and all these various contracts are adding up to the same purpose, to get to the same end. Well, now it could be viewed as a single contract, a single performance obligation. Notice the example. You got a customer agreement, no signature, work begins, you incur costs. Is there a contract? Contract A was for the equipment. Contract B was for service on that equipment. Do you treat them as separate contracts or one contract? They're essentially the same end result. Now, how do you identify the proper accounting treatment? You notice the comments. If distinct goods and services are added, the contract price is increased. Now you've got a separate contract. Now, I've already mentioned that there is some leeway there. If you just add a few items, somebody increases the amount of licenses, for example, they're taking for a product that they own from you, you might want to leave that alone as a standard contract. Essentially, it hasn't changed. But that becomes a decision that you need to make as to whether you have to shut that one down and create a new contract or not. Most software will allow you to make adjustments and keep right on going, because we're not going to make that decision for you. We're going to allow you to make that decision on your own. All right. So keep those points in mind. I'm not going to cover every single bullet point because you're going to get to see these anyway. And we've got, don't get scared, 50 slides to go through before we take a look at real life examples. So let's go on to the next stage. How do we identify performance obligations? Well, first of all, it's a promise. You're going to do something for the money the customer pays you, right? And you might have multiple goods and services, and you want to account for them distinctly. So the customer is going to benefit from this obligation, or each obligation is distinct in terms of the contract, and actually, pardon me. And you notice the example there. This is a very common one. You've got hardware that you're selling. It's a one-time item. You've got software that you're selling. It's a one-time item. You've got service contract that might be renewable. You might even have professional services that are unknown as far as the actual dollar amount on a month-by-month basis, but you've got an estimate for the full contract. So depending on the actual wording, you might have a promise for additional goods and services as well over and above what they do. For example, setting it up, configuring it, training, those kinds of things might be considered in the contract as well. So you need to figure that out for yourself. So is your mind blowing up yet? There's a lot of stuff here, but once again, this is all well and good. This is all looking at the actual 200-page document and trying to extract from it the key points. Hopefully, when you finally see the product in action, you'll go, oh, thank God. It's not as complex as it sounded at the beginning of the presentation. And believe me, it won't be once we finally get there. So now, transaction price. This is where it gets interesting. What is the actual transaction price? Variable consideration. It's the most likely amount. And usually you'll say it's all or none. And the example we're going to look at is going to explain that. Maybe you have just a percentage, probabilities. And of course, you have to look at that. So notice the example. You got 250 million plus 10,000 for each day that you're early or late. So based on the look of the contract, it might be a penalty of 150,000. So what do? You got two choices. You can actually, in the second choice, either be 150K that you're going to incur or nothing. It's an interesting scenario, but that's determining the transaction price based on the contract, because contracts often have these pieces of information that says if you're late, it's going to be so much of a penalty. If you're early, it's going to be so much of a benefit. How do you put that down in writing and put that on the books at day one? So you need to come up with some kind of performance obligation. Expectations is probably a good one. Maybe it's going to be 10K per day, or maybe it's going to be the most likely amount. Maybe the customer you're dealing with is very good at meeting deadlines. So that 10K, that's not going to factor in. So you leave it out altogether. That becomes a decision of you, the customer, or you, the contractor, to understand what likely is going to happen with your transaction price. And of course, now we get into the time value of money, your net present value of your dollars and cents that you're spending. Only if it's significant. So if you're talking about a $5,000 item and you go over 2 years, it's not really material to the accounting program, unless your total business only does $10,000 a year, which you're not looking at using GP or any of the other Dynamics ERP products. It's going to be treated like a loan. You're going to have actual interest income, expenses. That requires an extra little bit of complexity when you're talking a long-term contract. So again, what's significant? As I said, if you're a $10,000 a year business, you're probably a little shop that your dad's letting you run. If you're a substantial business, $50,000 might mean something that has to be looked at as a long-term contract if it's over 2 years, and you got to figure that out. The good news is that you get to decide the rate for the net present value. Whatever's present to your bank, I often say to the customers, hey, go talk to your bank. If they say the interest rate today is 2.5%, great. That's the rate you use for your net present value. But you can also put it in the contract itself. So even though the bank rate might be, say, 2.5%, you could turn around and say, oh, no, this contract dictates it's 3% or 2%, and away you go. And that becomes your net present value calculation. Where that really comes into play is not so much on your everyday software and services and that kind of business, but where you're talking leasing, where the lease might be over 20 years. Obviously now, if you're leasing something at $4,000 or $5,000 or $6,000 a month over 20 years, the net present value really does come into effect. That's a different standard. So just understand that generally speaking, the net present value of money is going to come into different standards, but it can, depending on the size of the performance obligation and the length of time that you're talking about, in a standard everyday kind of contract. All right. So again, the rest of these items you could look at later, things like rebates, gain and loss on the operations, that kind of thing. also come into play. So hopefully you're getting the idea of, it's not just a matter of saying, what's the fair value of something? It is a matter of understanding what is a contract and how do I allocate the price of that contract. Oh, and by the way, that's our fourth point, allocating the transaction price. Key aspect of it, and this is what you're going to see in the short little demo that we're actually going to show with GP, with the contract module installed, with the ASC 606 compliance capability active as well. Standalone selling price, that's the key. If you have 5 items in the contract, what does each item typically sell for? How much is it? Now, you might have a discount on that contract. You might have a computer monitor that you're throwing in free, or a mouse and keyboard you're throwing in free. But if you were just selling them by themselves, what would be the price of that keyboard and mouse? What would be the price of that monitor? That's how you figure out what the real value for each item is on a contract. And we're going to show you some numbers here. It's going to get a little more interesting in just a couple of minutes. Used to be known as fair value. Now it's standalone selling price, and that might change again in the future, but today it's still standalone selling price. All right. So that's basically what we're talking about, is how do I figure out the value of a contract? I figure out the standalone selling price of each and every item on the contract. So keep that slide in mind. Might be something to refer to, and we're going to go back to that later. So here we go. We have a deal. We're going to sell this computer system for $1,000. All right. I've got the computer standalone selling price $700. The monitor's $300. The keyboard and mouse is $100. And the service contract is really cheap. It's only $100. So $1,200 for this computer, but I'm only selling it for $1,000. So what do I have to do? Well, I need somehow to calculate those numbers. The item standalone selling price divided over all the total price times the selling price. So now what do I got? 700 by 1,200 times 1,000 is 583.34. So you get what's happening to the numbers. You can do this on a spreadsheet. No problem whatsoever. So let's start looking at it. All right. So keep in mind that if you're selling this as a system, no breakout, it might have to be just simply all deferred by itself rather than the selling price. But don't worry about that today. We're going to assume we're going to use the standalone selling price. So what does that mean? Final point first. Recognize the revenue upon satisfaction. I think that's almost self-explanatory, but the deals are there. When you've delivered everything the contract says, okay, now they're taking it over, you can recognize the revenue for that particular performance, i.e. maintenance contract, $1,200 for 12 months, you recognize $100 a month because that's when you've performed the obligation. The first month has gone by, you recognize that $100. 12 months go by, you've recognized the full amount of the contract, all right? When you deliver a completed building or a completed service, you recognize the revenue for that particular item. So this recognition, as you notice in the last bullet point, can be straight line, month by month by month, year by year by year, or it can be milestone or event-based, or even percentage of completion. Depending on what you're using, what you've agreed to in the terms of the contract, you may have any of these 3 or 4 methodologies utilized to finally recognize your revenue. What is nice is products like ours integrate the revenue recognition with the contract functionality, so users don't have to do anything. They just simply process the invoices and the revenue gets put on deferral or recognized right away or whatever it needs to be, and the contract has all the right terms and conditions upon it. Bottom line is, when the customer gains control or gets the benefit, that's when you recognize the revenue for that particular obligation. So here's the question. What's control? When the customer now has to pay for something that they've used, or has legal ownership, or has actually taken possession of it. You built a building, and they're now sitting in the building. And of course, they also have to incur the risks and rewards of ownership. Something happens to the building, they got to take care of it. They got to put insurance on it, and so on and so forth. Then they've accepted that you've provided the service for them. So, long-winded, a lot of detailed explanation. Bottom line, these are the 5 steps. You need to decide what's a contract. You need to look at the performance obligations. What do we have to do as a company to satisfy this contract? The contract, by the way, could have simply been an invoice. What do I have to do to make sure that I provided everything in that invoice? Some of it might have been hardware. Has it been delivered? Some of it might have been set up in implementation, configuration. Has that been done? Some of it might be a maintenance contract. Annual maintenance contract. Have I recognized and performed my obligations on a month-by-month basis so I can recognize that particular aspect of the revenue? What's my real price for each item? Forget the fact that they're all grouped together on a big invoice, discounts, free items. What's the real value for each and every item? And keep in mind that the discount, it goes away. It doesn't exist. It's not an item. You don't sell it. All you've done with the discount is modified the base price of the contract. And then, of course, we talked about revenue recognition. Now, this is going to get real exciting. For you folks on the call that only have to deal with ASC 606, you can close your eyes and take a little nap. But if you've got a business that goes across and works in other countries that are under the IFRS 15 rules and regulation, we stole from KPMG some key differences between the two. Most of the time, I can tell you from experience, very little of this matters, but they do exist. So we're going to go through these next slides fairly quickly. Shipping and handling. We can have a policy to treat shipping and handling as a fulfillment activity in ASC 606, but you get to decide that individually in IFRS 15. All right, so very, very similar. For the most of us, we're not going to pay any attention to this. Transaction price, dates are key here. ASC 606, the transaction takes place at the contract inception. IFRS 15, you can have different inception dates. Date received, date delivered, date shipped, all can apply in IFRS 15. Again, for most of us, most of our businesses, these don't matter, but they're here for informational purposes to know that it's not exactly the same. So if you're a US-based company that's used to dealing under ASC 606, say a year down the road or 2 years down the road, and suddenly you expand to other companies, say in Europe, you need to understand that there are some exceptions to the rules here that make it ever so slightly different, all right? Now, again, under GAAP compliance and IFRS compliance, there's different rules here as to whether or not the company can dictate whether sales and taxes are part of the product. ASC 606, you don't get to dictate that. You present all sales and similar taxes on a net basis, and away you go. Again, you probably don't have to give any thought to that or worry about that at all. But here's an interesting one. Reversal of previously impaired contract acquisition and contract fulfillment costs. So something hasn't worked out in the contract. What do I do with the previously incurred costs? Well, under IFRS 15, you can actually recognize a reversal of an impairment loss. You can actually get the benefit back. In ASC 606, nah, sunk costs, leave it alone, can't do anything with it. It's a done deal. It's over and gone. Simple as that. All right. I'm not even going to talk a lot about this one. You'll get to read it as a slide. But you can have non-financial assets like buildings, plant, and equipment that get sold, and you have to account for it in a certain way. Under the IFRS 15, when you do that, it's just simply the gain or loss on the fair value of expected proceeds. So if I sold the building for $1 million and it was a $2 million building when I bought it, I got $1 million in losses, go ahead and take care of that. But under GAAP, you get to estimate the transaction price following a little principle or a consideration guidance that is subject to constraints. So you've got some limitations, but you've got some flexibility under ASC 606 that you don't have under IFRS 15. I like this one. Onerous contracts. We never have them, right? We never have a contract that, oh my God, I wish I'd never entered into this contract. I'm losing my shirt. Reality is it does happen. IFRS 15, you can recognize a provision for unavoidable costs of meeting obligations when the contract's exceeded its economic benefits. So you can do that. All right, so now under GAAP, there is no guidance for doing that. It focuses only on the type of contract or the arrangement that you have. And you notice the consideration for preparers, likely not to remain aligned for the foreseeable future. Now again, this is one of those oddball things that probably would very rarely, if ever, come up for you. So only if you're worried about international stuff do you have to be concerned with that. Okay? Now here's where I find it interesting. I have to smile at this because it's so usual. The dates are always fluid, and they typically go to December of 2019, I think it is now. I'm not even sure if it's 2020 yet. But you know what? Because it's so onerous to get this in place, there's so many companies rushing to build software to do this that the standards keep moving as far as their implementation dates. So this is the example of the slide originally prepared at the end of last year. The dates have already changed, and they may well change again. The reality will be, though, that one day these standards will take effect, and you're going to have to be bound by them. All right. We're getting to the point where I can actually show you some stuff that might be a little bit more interesting than looking at all these details that you're seeing here on these presentations. Definition of completed contract. Pretty simple finally in this one here. When you've transferred all the goods or services, when you've got your 12 months of maintenance all done, you've taken care of the customer, nothing here like it's rocket science. Very, very little differences between GAAP standards for IFRS 15 and GAAP for ASC 606. So we won't spend a lot of time here. You've got the information in the slide. You can look at it later, okay? Now, disclosures, remaining performance obligations. Under IFRS 15 over on the far right, the entity needs to estimate variable consideration for disclosure purposes only when those estimates are not needed for the recognition of revenue. What does it all mean for us? Really not much. Most of the contracts that I deal with here, there's not much involved in this. We have some exceptions to the rules that take place. If you're in the business that deals with these kinds of things, you're going to read this and you're going to say, oh, look at that, I can do this. Otherwise, for most of us, it's irrelevant information, so we're not going to bore you with that too much right now. And this is the consideration of that as well. You've got a lot less requirements under IFRS 15, so it's kind of a benefit in a way if you're under that than we do in ASC 606, and that's basically all this slide is telling us. Now, let's get back to ASC 606. What are our areas of concern? Now, all the detail stuff that I've just talked about, all the technical jargon, almost legal speak that we've just looked at, kind of put that in the back of your mind. Let's talk now about real world and real life. So what do we need to be concerned with? What if we don't change at all and something magical happens, like the like the implementation dates keep changing, those kinds of things? Well, then we don't have to worry about it. But you notice there are dates here that are flexible right now, but they're changing a little bit, but they will eventually take place. So I'm going to reiterate what I said about 5 minutes ago. Understand that these things will happen. You will be locked in. You will be accountable, both private and public companies. Private companies might not worry about this too much, but understand that if you go to sell your company to a public company, or you go to a bank looking for financing, they may well expect to see that you are GAAP compliant with the ASC 606 rules. So keep that in mind. Just because no one's going to check up on you doesn't mean it's not going to impact you at a later date if you don't put yourself in compliance with the standards. All right? Now, solutions versus products. Some items are not distinct in terms of the contract, all right? They may need to be deferred. So for example, you notice a solution that includes hardware, software, and a 3-year service contract, the whole thing might need to be deferred if it's being sold as a package with no differentiation with what's in there. You're just simply selling this package, this service, which includes hardware, software, and a service contract. The other aspect of it, and I remember this in my accounting days when I was taking my CPA designation. What is materiality? Well, if you look at the example mentioned here, it's immaterial if you can, if it depends on the amount of volume of your contract. So $1 million contract, you got a performance obligation of $50,000. You don't need to account for that separately. But what if you've got a $100,000 contract with a performance obligation of $50,000? Yeah, you need to account for it separately. You get to decide what's material, you and your auditors, and that's pretty common sense as far as that's concerned. And finally, licensing. I'm going to leave that for you, but you notice the last comment, software revenue will be recognized at inception of license, not over the term of the license. So again, little points that you and your auditors have to keep in mind, or your accountants have to keep in mind when you're trying to transact these particular ASC 606 requirements. And there, contracts must be reviewed. In real life, not done very often, but really you're supposed to look at the contract on a month-by-month basis for each reporting period to see if it's still existence, it's still a contract, has it changed, is the customer paying the bill? I'll give you an example. We have customers that sign contracts with us and they're supposed to pay support and maintenance, and they stop doing that. Well, is it still a contract? At what point have they said, you know what, we're backing out of this, and whatever you need to do legally, go ahead and do it? So you have to keep that in mind as you're looking at your contracts. There may be some of them you can shut down because somebody else is not meeting their performance obligations, not paying the bill, or whatever the case might be. So you do need to review it periodically. And even for pricing, has the price changed dramatically on a particular aspect of your contract since you signed the contract? You might have to make some adjustments there as well. Or when is a contract not a contract? The final bullet point. Have I added too many things? Have I increased the price too dramatically? Have I changed the basic makeup of the contract? Well, maybe I have to shut the one contract down, create a brand new contract, pardon me, and start over again. Now let's get to the meat and potatoes. I guess that was meat and potatoes. Let's get to the good stuff. ASC 606 in Dynamics. Let's talk about how it affects you in your GP world. So how do you become compliant with ASC 606 in Dynamics GP? You can't. That's still true today. It was true when this file was put together a year and a half ago. It's still true today. You have to use Excel or some third-party ISV application like the one we're going to show you briefly, and we'll take a look at what that means. Excel, you can do it, and I know you can do it because most of the people we talk to that want us to demo our product to them, they use Excel. So they build a complex spreadsheet, they figure out the standalone selling prices, reallocate the revenue calculations, and put a journal entry back into the ERP. What's the problem with that? Well, for one, it's time consuming, right? For two, it can be complicated. For three, it's not a good use of your time if you've got 100 contracts or 1,000 contracts. You're going to hire one or two people full time just to do the Excel spreadsheet calculations. And they look for something like this. There's an example. I got a hardware item, a setup fee, software, maintenance, professional services, and the ever-present discount. And one time, monthly, you get the idea, the different terms of the item that you've got on your contract. Now, I've got my standalone selling price column. It's a little different in some cases than what you see in other places. And there's my contract standalone selling price, $241,000 compared to the contract value of $214,000. How do I reconcile that? Well, let's reallocate. I've done all the math here in the reallocated contract revenue based on the standalone selling price compared to the contract price. And now I come up with $214,000. But you'll notice the $15,000 contract value in the third column is not the same as the $15,095 in the sixth column, and so on and so forth. This is what you do in a spreadsheet, and then you enter the journal entry to go ahead and recognize all that information. There's your formula. All right? It's not a complex formula. That's not the issue. The issue is if I've got a lot of contracts and GP doesn't handle it natively, it means I've got to do this on every single contract, figure out the fair value of everything, or the standalone selling price, pardon me, on every item and do all this math. That's where this gets onerous and gets error prone. I'll keep going here. Now we've got everything broken up. My contract revenue clearing account, my $41,000. See, my extended price, the first column was $41,000. Break it over to my final column. Yep, $41,000. So I'm good to go. I got it done. But you'll notice there's a lot of columns, a lot of calculations, a lot of information that has to be fed in because GP doesn't natively do that for you. So we do. We've got this ARC-B, Advanced Recurring Contract Billing. We've got this Advanced Revenue Expense Deferral module and the Multi-Element Revenue Allocation. The last one, called MIRA, can be pronounced ASC 606 compliance. Same thing. MIRA, Multi-Element Revenue Allocation. Now, the MIRA is built into ARC-B, the Advanced Recurring Contract Billing, but it is technically a standalone product that works simply off an invoice that you create in GP with multiple items on it. And I'm going to show you in GP just in a minute the simplicity of using the product, because we've done all this complicated math that we've talked about for the last 30 minutes. We've put that into the product so you don't have to worry about it. You don't have to have the spreadsheets. You don't have to do those calculations, all right? So we allowed you to do milestone, event-based, line-level deferrals, straight line, all of that, believe it or not, in a fully automated process with the product that we and our turnkey folks work together with. And we can do the standalone selling price calculations, and all you have to do is set it up initially and away you go. All right, so here we go. The contract module can do all of this. Scheduled billings, milestone billings, line level control, metered, consumption, usage, all of those things that you see here, ARC-B can handle. And then when it goes to generate the invoices in GP, ARED steps in and says, oh, you've designated this to be a deferral item. I'm going to automatically create a deferral schedule for you. Zero user intervention required. Once you've set up an item as a deferral item, it will be deferred upon invoicing. It's pure and simple as that. Very, very powerful tool to eliminate spreadsheet errors that you often get when you're keeping track of all your deferrals on a spreadsheet. So it works perfectly with ARC-B, the ARED module, but it's also a standalone module that if you just need deferrals, it can stand on its own 2 feet as well. And finally, we've got the ASC 606 product that allows you to figure out what your standalone selling prices should be, create these IDs, these tables, so you know how to allocate your contracts properly. And by the way, even though we're talking about GP, you'll notice that this here that we're looking at is actually F&O. So if I continue to scroll through this, you'll see that all this information, even splitting revenue, that's a common one that we get asked. Hey, can I sell a single item, but split the revenue according to the standard across 4 or 5 deferral accounts? The answer is yes. It's out-of-the-box functionality with our product. So if I can just scoot over here, see if I can find my product. This is Microsoft Dynamics GP, all right? So when I look at this particular product, I'm going to go take a look at this product called, whoops, I got to bring it back up here. Give me half a second. I'll take less than 5 minutes here just to give you an idea of all the technical stuff I showed you. Don't panic about it. We've got it covered for you. So when I look at my multi-element revenue allocation and I look at my fair value setup, all it is a table. You'll notice I've got items that tell me what is it that I can evaluate this item at. I can value it at an amount, at the actual sales amount, at the list price that I have in my GP inventory, or a percentage of another item. Think of support, for example, for software. I list all my items in here, and then when I put these items on a contract, automatically Mira will go take a look at this table, see your fair value methods, look at your standalone selling prices. That should be changed, by the way, to standalone selling price. Take a look at all the values and recalculate for you. So your invoice to the customer can still say discount, free item, and so on and so forth. But what goes on your P&L, that math will be done here in the background. So all that technical jargon we talked about for 30 minutes, that will all be done in an automated fashion for you so that you know when the auditors come in, you are good to go. So there's the table, all right? That goes into your GP database and you're good to go. So let's go take a look at a contract though. If I bring up my advanced recurring contract billing module, I'm going to bring up a schedule and let's go take a look at schedule, I think 81 might work. So there's my schedule 81 in GP with our ArcB product installed. You notice all these items, you might have noticed that they are listed on my standalone selling price table. That's all I've done is created the table, populated it with the correct selling prices, and I've got my contract here that's going to look like this. Got the discount, got the actual values. But what happens in the background? Let's go look at revenue allocation up here at the top. There's my contract value or my invoice value, same thing, right? There's my fair value or standalone selling price methodology in here, and there's what the standalone selling price should be for all these items. You notice my discounts value is 0. In other words, get rid of it. There's no such thing as 0. If I had a price here of 0 on these items, that would be gotten rid of too, and the actual retail value or standalone selling price of that item would have been put there. So you notice now here's the contract fair value, but look what is going to go on my profit and loss statement. It adds up to the contract value, but it eliminates any free items. It eliminates discounts. It eliminates that totally from your calculation, recalculates the contract based on your true standalone selling price in harmony with the ASC 606 requirements. That's what goes on your P&L. When your auditors come in, they can look at each and every one of these contracts, go to the P&L, do the trace, and see that the correct amounts were put upon the contracts that you have. Very, very powerful and simple. So all the complications we talked about, all the 200 pages of ASC 606 boils down to the table I showed you and ArcB using that table to recalculate the contracts for you, or the invoice, simply doing it for you from day one. So the salesman can leave the invoice the way it is. The AR clerk can input the invoice, the way it is with discounts and free items and whatever the case might be. Mira will take a look at this, change it around, and away you go. Simple as that. So let me close back out here and go back to my presentation. Where did it go? Where did it go? Let me bring it up here a second. Sorry, guys. And there it is right there. So we're back to the agenda here. I'm going to go all the way to the end of the presentation. I must have shut it down. I apologize for that. So as we're looking, I want to explain this again. This is F&O. We've got Business Central, and of course, we've got GP covered for you. So we're at the end. Any questions? Back to you guys.
Thanks, Don.
Okay. You're welcome.
Brad, do you know if there were any questions in the question panel?
Yeah, sorry about that. I didn't realize I was had my headset muted. We did get one question from Michelle. I'm sorry, we initiate our billing in another system and import it into GP. Will this work?
Okay, that's a great question. Typically, if you noticed, and I guess I didn't get to show you that in real life, the contract billing module that we present, it creates the invoices. So the only change, and speaking at a high level here, that you would have to make is import the data into the contract module and let it generate the invoice. So you can dictate to ARC-B what's going to be invoiced by simply importing the data from a third-party product. But if you bypass the contract module and invoice directly, the contract module can't help you. It needs to create the invoices so it keeps track of what's been issued, what hasn't been issued, and so on and so forth. Does that answer the question, I hope?
Yeah, I think so, Don. And just to add to that quickly is the mirror piece, the piece that allocates the revenue based on the standalone selling price, does that on an item by item basis. So if you're just billing outside of GP and bringing in summary data to do your at GL level in GP, then our module isn't going to be able to do those allocations at the GL level. It needs to do it at an actual line level basis.
Yeah, so you'd have to create an actual invoice, and it can pick up the invoice and do the allocation for you. So if you're doing it just to create the invoice, yes, it can still work. But then you would have to have that mirror piece of the puzzle as a standalone product.
Okay. Well, that looks like it's it for the questions for now. If anybody has any more questions, please feel free to submit them at this time. Don, did you have anything else that you wanted to add before we wrap up here?
No, I just want to emphasize that it is a complicated process, but if you buy the right solution to handle it for you, it doesn't have to be for you. The solution can take care of the complications.